Are there any points you think people are missing about the nature of the layoffs and the shutting down of the economy right now? And I don't know what kind of letter-shaped rebound you think we might have at this point.
Well, look, we have no playbook for this. There's no real template that we can rely on in the past. I think that we have to build an assumption here that we could be in this isolation mode or the social distancing, through not just the balance of this quarter, but into July. I could see that the Canadian government, the Australian government, have made some comments along those lines. Look, I really believe that we will get through this, and we're in the eye of the storm right now. We're just entering into it. But I don't see that there's going to be a significant recovery even after we see this improvement in the case curve and we start to leave our homes and start to work again. I think that until we get the most important data point for me is when we get a vaccination. That's when things will get back to normal or quasi-normal. Before then, I think that we're going to get through the eye of the storm in the next few months on the economy. But the recovery until we get a vaccine, that's going to be the point in which time I think people are going to feel more comfortable spending the way that they were before the virus hit.
Yeah, we talked to the chair of Moderna last hour, which has one of the early vaccine candidates, and he emphasized that we're going to need all hands on deck, that we're going to need a lot of supplies, maybe a lot of different approaches. Theirs is RNA-based. Others are a little bit different. So I wonder if we're really ever going to have that single headline or that clarity.
Well, it's going to be, piecemeal. I mean, even getting a treatment would be helpful to some extent. We're talking about, what is it that's going to make not just people go back to work. I mean, you're seeing that in China if you believe the numbers, but it's also clear to me that when you look at the sales data that people really aren't spending the way that they were before. And this is an economy here in the States where 70% of GDP is consumer spending. I just think there's going to be a prolonged period of caution. And then on top of that, someone's going to figure out who's going to pay for all the fiscal largesse, who's going to pay for everything that had to be done to get us through, because there is no such thing as a free lunch. You'd have to believe that the current generation of taxpayers, some of us are going to be paying for this. It's not just going to be future taxpayers. And that tells me that as we go into the future, maybe the most important behavioral aggregate we want to pay attention to is the personal savings rate. Because I think we come out of this, of course, we went into it at every level of society and business, and portfolio managers went in with almost no cash. Next thing you know, an economic crisis becomes a liquidity crisis. So I think, how businesses and households approach liquidity, how they approach cash, how they approach the balance sheets is going to be a lot different than it was before. That's even when we get past the eye of the storm. This is going to be something that holds back aggregate demand growth, which in other words is the economy. Is going to be a new form of frugality, but a rising savings rate that's going to really cause this to be, I'm not calling it an L shape, but I think it's going to be just a long-term series. I'm talking about years of low-case W's. That's what we're going to be seeing, bouncing along the bottom.
Yeah, I hope you're wrong, but you make a lot of good points. So when you talk as well about the tax load that the current generation may face, does that imply that happens only after interest rates start to rise? Because otherwise, can we just issue as much as we need to?
I guess that's actually a great answer. Will the answer ultimately be the Fed? Did we all of a sudden head into debt monetization, or we're talking about in theory the modern monetary theory, and here it becomes reality? At some point, if we go that route, and the Fed loses control semi-permanently of the monetary base, then you're going to find people who have been in the declining bond yield camp and the disinflation camp calling the other way. Like basically we come out of the other side of this mountain with a lot of inflation if this ends up on the Fed's balance sheet permanently. So like I say, no such thing as a free lunch. It's either going to be higher taxation in the future, and that's going to cause the savings rate to go up. It's called accordion equivalence. Or if it's done on the Fed's balance sheet, we're going to come out of this with more inflation than anybody would have thought.
People aren't going to believe that, though. They'll say it doesn't matter how big the Fed's balance sheet is. It's not going to be inflationary.
Well, when we get past the worst of the recession, then and you're taking a look at what happens, say, between the money supply and velocity, And look, I've been in that camp for a long time. I was saying for many years that QE on its own was not going to precipitate a big inflationary cycle, and it didn't happen. But outright debt monetization, I will tell you that to say that this will not be inflationary down the road is to say that you're betting against history.
Okay.
And so I would highly advise against doing that.
Dave,
There's no such thing as a free lunch. People seem to think that we can just rely on the Fed's balance sheet, that it's infinite, and if that's the case, you could ask yourself the question, why haven't done this before? We could have avoided every recession in the past. Just use the Fed's balance sheet. There's going to be risks on this down the road, and the risk will be that in the next economic expansion, and once we say we absorb the savings glut that we have, there will be inflationary consequences. It's just going to be, what the time frame is for that.